Silver just crossed 75. Most people hear that and think one thing. Price went up. But that is not what just happened. This was not a rally. It was a fracture. Markets move higher all the time. Structures do not break very often. And when they do, it never feels comfortable in the moment. Because a structural break does not announce itself with celebration. It shows up as confusion, as disbelief, as people asking, how did this happen so fast? That is where we are right now. Silver did not climb step by step. It did not hesitate. It did not ask for permission. It pushed through a level that had quietly defined risk for years. And once that level failed, something deeper gave way. If you are feeling uneasy watching this, that reaction makes sense. Uncertainty is the natural response when old reference points disappear. This is not about excitement. It is about realization. The rules that kept silver contained no longer apply the way they used to. And when a market loses its old boundaries, it does not drift. It searches. So before you decide this is just another move that will fade, pause. Because what you are watching is not silver getting stronger. It is the framework around silver breaking down. And once that happens, the story changes, whether you are ready for it or not. I am not looking at this from a textbook. I am looking at it from memory. I was in the market in 2011. I remember how silver felt back then, the disbelief, the speed, the way price moved faster than explanations. I remember watching desks go quiet as positions unraveled. I remember banks changing rules overnight, margins raised, limits tightened, phones ringing more than usual. Back then, people kept saying it could not last, that it was irrational, that it would fix itself. Until it did not. What you learn in moments like that is simple. Markets behave very differently when pressure builds under the surface. And by the time the public narrative catches up, the damage, or the opportunity, is already done. I am not here to tell you this ends tomorrow, or that it only goes one way. I am here because the pattern feels familiar. The early confusion, the quiet positioning, the sense that something is happening that does not fit the old explanations. When you have seen squeezes form before, you recognize the early signals, not in price alone, but in behavior. Every time a market moves hard around the holidays, the same reaction shows up. People shrug. They say it is thin liquidity. They say traders are on vacation. They say the move is fake, and it will fade as soon as real money comes back. That instinct makes sense, because most of the time, that is exactly what happens. December rallies are usually quiet, low volume, few participants. Prices drift higher, simply because there is nobody around to push back. But this move in silver does not feel quiet. It does not feel empty. And it definitely does not feel fragile. I want you to think about something. If this were just a holiday pump, who would be buying? Retail traders clicking buttons between family dinners. Algorithms taking advantage of thin order books. Those moves are light. They float. They disappear. The moment pressure shows up. What we are seeing right now is the opposite. Every push higher is being met with more participation, not less. More contracts. More engagement. More conviction. That is the tell. Fake rallies feel nervous. This one feels crowded. It feels heavy. It feels like people are stepping in with purpose, not boredom. So if you are looking at this and thinking, this is just another holiday fake-out, you are not stupid. You are just applying the wrong mental model. Because this is not a market drifting upward while nobody is watching. This is a market moving higher, while everyone who matters is stepping closer. And once you see that difference, you cannot unsee it. Now this is where we stop talking about feelings and start talking about facts. Because markets can lie with headlines. They cannot lie with positioning. There is one number that matters more than almost anything else right now. Open interest. Open interest tells you how many contracts are open and active. How many players are actually in the arena. How much real risk is being taken. And here is the rule that almost never gets broken. When prices rise sharply, open interest usually falls. Traders take profits. Positions get closed. The crowd thins out. That is normal. That is healthy. That is what textbooks are built on. But silver is doing the opposite. As price has pushed higher, COMEX silver open interest has expanded to roughly 165,000 contracts. That is an increase of about 18% compared to this time last year. Let that sink in. Price is rising, and participation is growing. Not shrinking, not hesitating. Growing. That is not supposed to happen in a fake rally. That is not what exhaustion looks like. That is not what a top looks like. This is what commitment looks like. Every one of those new contracts represents someone stepping in and saying, I am willing to hold risk here, at higher prices, with more exposure. That takes conviction. That takes capital, and that does not come from tourists. If this were a weak market, open interest would be collapsing right now. Instead, it is expanding, which tells you something uncomfortable but important. This move is not being driven by people leaving the market. It is being driven by people entering it. That is the moment where experienced traders pause. Because when price and open interest rise together, it usually means the story is just getting started, not ending. And that is why this matters more than any headline you will read this week. Here is the part most people miss. Open interest does not rise because people feel excited. It rises because someone is willing to stay. Small traders chase price. They jump in, they jump out. They do not build exposure when volatility increases. They reduce it. Rising open interest at higher prices tells you something very specific. Positions are not being closed. They are being opened. And not just by anyone. Large funds do not add risk casually. They do not wake up and decide to put on size because of a headline or a feeling. They wait, they study. They step in when the odds quietly shift in their favor. That is what this looks like. When open interest expands during a rally, it means capital with patience is taking positions. Money that can sit through pullbacks. Money that does not panic when the screen turns red for a day or two. This is not fear of missing out. This is preparation. It is the kind of buying that happens before the story becomes obvious, before financial television starts talking about it every afternoon, before your neighbor asks if silver is going to 100. Smart money moves early, and it moves quietly. You rarely see it in price alone, you see it in structure. Open interest rising is the market telling you, without emotion, that bigger players are committing before the crowd arrives. And once that kind of money is in, the game changes. This is the moment where the room goes quiet. Because now we are no longer talking about participation. We are talking about position reversal. Managed money has flipped. These are hedge funds, commodity trading advisors, institutional players who move size, not opinions. For most of this year, they were not long silver. They were cautious. Some were neutral. Many were short. They were betting on slowdown, on falling industrial demand, on the idea that silver would stay trapped, controlled, manageable. And then, something broke. According to the latest positioning data, managed money is now net long, roughly 28,000 contracts. That is not a small adjustment. That is a full turn of the wheel. Think about what that actually means. These players did not just cover shorts and walk away. They covered, realized they were wrong, and then stepped back in on the long side. That is a dangerous transition for the market, because this is how squeezes evolve. First, shorts feel pressure, then they feel pain. Then they buy to survive. But the real acceleration happens when those same players decide the upside is now the safer bet. That is when selling disappears. That is when pullbacks get shallow. That is when price starts moving faster than logic feels comfortable with. This is not emotional buying. This is capital admitting a mistake and repositioning. And when large funds flip like this, they do not do it for a quick trade. They do it because their entire thesis has changed. That is why this moment matters. Because when managed money goes from leaning against the market to pushing it forward, you are no longer watching a rally. You are watching a squeeze turn into a trend. Here is how a squeeze really works, without jargon. And once you see it, you will never forget it. Imagine you are short silver. You borrowed it. You sold it. You are confident it will fall. At first, the price moves against you a little. You tell yourself, it is noise. You wait. Then it keeps rising. Losses grow. Your screen starts flashing numbers you do not like. Risk managers call. Margins get tighter. Suddenly, this is no longer a trade, it is a problem. At that point, you have two choices. Add more to your short and pray. Or buy back your position and get out. Most choose survival. That buying pushes price higher, which forces the next group of shorts to do the same thing. It feeds on itself. But here is where it gets really powerful. Some of those shorts do not just exit, they flip. They realize the pain is not random. They realize supply is tight. They realize momentum is real. So they go from defending against price to chasing it. That is when the market changes character. Pullbacks stop working. Dips get bought immediately. Every hesitation turns into fuel. This is no longer fear buying. This is belief replacing denial, and that is why squeezes feel violent. Because they are driven by people being forced to change their minds in real time. By the time the crowd understands what is happening, the price has already moved far beyond where logic says it should be. That is the anatomy of a real squeeze. Up to this point, everything we have talked about lives on screens, contracts, charts, positions. But eventually, every paper market has to answer one question. Can you deliver the metal? This is where the story stops being theoretical. COMEX deliveries this year have surged. Not trickled, not normalized. Surged. Tons of silver are being demanded for delivery, instead of being rolled forward on paper. That is a quiet but powerful signal. It means someone does not want cash settlement. They want the metal. And this pressure is not isolated. London is tight. Very tight. The London bullion market is where physical supply is supposed to be, deep, liquid, reliable. When traders in London start talking about tightness, it means bars are harder to source. It means inventory is spoken for. It means delivery timelines stretch. This is not something retail investors create. This comes from industrial users, from institutions, from players who actually need silver to exist in the real world. Here is the uncomfortable truth. Paper silver can be created endlessly. Physical silver cannot. When physical markets tighten, at the same time paper prices rise, the system starts to strain. Because every short position is based on the assumption that metal can be found when needed. When that assumption weakens, behavior changes. Shorts become cautious. Banks become defensive. Liquidity dries up where it used to feel automatic. This is the moment where price stops being the story. Availability becomes the story. And availability does not care about opinions, indicators, or headlines. It only cares about one thing, whether the silver is actually there. That is why this phase matters so much. Because once the physical market speaks, the paper market has no choice but to listen. This is the point where markets stop being polite. When you are short silver, everything you believe rests on one assumption, that when the time comes, you can find the metal. Not a price, not a chart, the metal itself. But when physical supply tightens, that assumption starts to crack. If you are short and delivery notices hit, you cannot negotiate with the market. You cannot explain your thesis. You cannot ask for more time. You either deliver silver, or you buy it at whatever price is available. And when silver is scarce, there is no fair price. There is only the price required to force someone else to let go. This is where moves become violent. Shorts scramble at the same time. Liquidity vanishes just when it is needed most. Offers pull back. Spreads widen. Every buy order lifts the market higher, not because of optimism, but because of necessity. This is not excitement. This is panic wearing a suit. Banks do not like this environment. Risk desks tighten limits. Traders stop adding exposure and start reducing it defensively. And once that mindset spreads, price stops responding to logic. It responds to pressure. This is why these phases feel chaotic. Because decisions are no longer about profit, they are about survival. When silver cannot be sourced easily, the market loses its buffer. And without that buffer, every imbalance hits harder. That is how orderly markets turn aggressive. And that is how squeezes leave scars long after the chart cools off. This is what happens when silver is no longer just a number on a screen. If you have been around markets long enough, this feeling is not new. Uncomfortable. Fast. Hard to explain to someone who has never lived through it. Silver has done this before. In 1979 and 1980, silver went from around $5 to over $50, not because everyone agreed, but because the system cracked under pressure. People forget how chaotic that period felt. Inflation was out of control. Trust in money was breaking down. And silver stopped trading like a commodity and started trading like an escape hatch. Moves were violent. Pullbacks were brutal. And anyone waiting for confirmation never got it. Then, it happened again. In 2010 and 2011, silver climbed from the high teens to nearly 50 in less than a year. That rally did not feel smooth either. It felt relentless. Every dip was bought, every doubt was punished, and every headline explaining why silver should stop going up was ignored by price. What both of those periods had in common was disbelief. People kept saying it was over, that it had gone too far, that it would revert to normal. It never did until the very end. These bull markets did not move because everyone understood them. They moved because positioning was wrong, supply was tight, and trust in the system was thin. That is why history matters here, not because it repeats perfectly, but because human behavior does. Fear, denial, capitulation, then acceptance. When silver enters this phase, it stops asking permission. It stops caring about what feels reasonable. And if you lived through those past cycles, this moment does not feel unfamiliar. It feels like the early chapters of something most people will only recognize once it is already well underway. Here is where the story changes. In every previous silver bull market, silver played one primary role. It was money, a hedge, a reaction to fear. That is no longer true. Today, silver sits at a rare intersection. It is still money, but it is also infrastructure. Silver is not just being hoarded, it is being built into the future. Every solar panel that goes up locks silver into glass and silicon. Every electric vehicle turns silver into wiring and control systems. Every data center uses silver to move power, manage heat, and keep machines alive. This silver does not come back. It is consumed. That changes everything. In past cycles, when price rose too fast, demand could fall. People could wait. Substitute. Delay. You cannot delay building power grids. You cannot substitute silver easily in high-performance technology. You cannot pause the digital economy. This time, demand is structural. It is not emotional. It is not speculative. And that gives silver a foundation it has never had before. At the same time, silver still responds to fear, to currency debasement, to falling trust in financial systems. So now it carries two forces at once: monetary demand pushing from one side, industrial necessity pulling from the other. Because silver is no longer choosing between being a hedge or a resource, it is being forced to be both. When people talk about demand, they often imagine something flexible, something that can pause, something that can wait for a better price. That is not the kind of demand silver is facing now. Solar energy is not a trend anymore. It is policy. It is infrastructure. It is national strategy. Every new solar installation locks silver into panels that will sit in the sun for decades. Those ounces are not coming back to the market. They are gone. Electric vehicles tell the same story. Each one uses silver for power management, safety systems, and control circuits. As production scales, silver use scales with it. There is no cheaper replacement that performs the same job. Then there is artificial intelligence. AI is not just software. It is buildings. It is data centers. It is massive electrical systems running day and night. Those systems need efficiency. They need reliability. They need silver. Here is the part that matters. None of this demand is optional anymore. Governments cannot reverse energy transitions overnight. Companies cannot stop building data centers without breaking their own business models. This demand does not care about price dips. It does not wait for pullbacks. It consumes what it needs. That creates a very different kind of market pressure. In the past, high prices could slow demand. Today, high prices simply reflect reality catching up. Once silver is embedded in infrastructure, it is effectively removed from circulation, and as more of it disappears into the real economy, the remaining supply has to do more work. That is why this feels irreversible, because the world has already committed to using silver faster than it can be replaced, and markets do not forgive that kind of imbalance. Whenever prices rise, the same argument appears. Supply will respond. Mines will open. Recycling will save the day. That sounds reasonable. It just does not match reality. Silver mining is not a switch you flip. From discovery to production can take 5 to 10 years, sometimes longer. Permits, financing, infrastructure, politics. Even if prices stay high, new supply arrives slowly, if at all. And silver has another problem. Most of it is not mined on purpose. It is a byproduct, pulled from copper, lead, and zinc projects that are driven by completely different economics. That means higher silver prices do not automatically mean more silver production. Recycling is not the solution people think it is either. Industrial silver is consumed in tiny amounts across millions of devices. Once it is embedded, it is expensive and impractical to recover. Recycling cannot scale fast enough to matter. So while demand accelerates, supply stands still. That gap does not close quickly. It widens. This is the part of the story that removes hope from the other side of the trade. Because there is no cavalry coming over the hill. No surge of metal waiting in the wings. Time becomes the constraint. And markets are brutal when time is the enemy. When demand outruns supply and nothing can respond fast enough, price has only one job: to ration what is left. That is how supply crises form, quietly at first. Then all at once. No market moves in isolation. Silver never has. Behind every major silver bull run, there is always the same quiet force. Money itself is changing. Right now, the Federal Reserve is no longer tightening. Rates are no longer a headwind, they are a question mark. And that matters more than most people realize. When interest rates are high, holding silver feels expensive. It does not pay a yield. It does not generate income. There is an opportunity cost. But when rates fall, that cost disappears. Suddenly, holding cash earns less. Bonds feel less attractive. And hard assets start to look different. At the same time, the dollar weakens. A softer dollar is not just a currency story. It is a confidence story. It tells the world that purchasing power is eroding quietly. When people sense that, they reach for things that cannot be printed. This is why silver responds so strongly to monetary shifts. It sits right at the intersection of currency and commodity. As central banks signal easier policy and governments carry more debt than ever, trust becomes fragile. Not broken, but fragile. In those moments, silver stops being ignored. It becomes relevant again. This is not about panic. It is about math. Lower rates reduce the penalty for holding metal. Weaker currencies increase the appeal of things with fixed supply. And when those forces line up with physical tightness and rising demand, the move stops being speculative. It becomes structural. That is why the monetary backdrop matters so much here. Because silver is not just reacting to its own market. It is responding to the value of money itself. When silver crossed 75, it did more than break a level. It broke a belief. For years, that number sat in the background as a line nobody expected to see challenged. Analysts talked about it quietly. Traders dismissed it. And then it vanished. Once a market clears a level like that, psychology takes over. 80 is not special because of fundamentals. It is special because humans think in round numbers. They remember them. They anchor to them. That is why price gravitates there. Above 75, there is no meaningful resistance built on memory. No trapped sellers waiting to get out. Just open air. This is where measured moves start to matter. If you take the range silver broke out from and project it forward, the math points higher than most people are comfortable with. Not because anyone wants it to, but because structure demands it. And that is how one target leads to the next. 75 becomes support, 80 becomes a checkpoint, and once 80 is accepted, 100 stops sounding ridiculous. Not because 100 is guaranteed, but because it becomes possible. Markets do not move toward numbers because they are logical. They move because enough people start to believe they are reachable. And moments like this, hesitation becomes fuel. Shorts see the next level and wait for failure. It does not come. Buyers step in higher. Confidence builds quietly. This is how parabolic phases begin. Not with euphoria, with disbelief. By the time excitement shows up, the move is already far along. That is why these levels matter. They are not predictions. They are consequences. When structure breaks and demand persists, price has only one direction left to explore. And that is what makes this phase so powerful. This is where numbers stop feeling small. When people talk about silver hitting $50 in 1980, it sounds like ancient history, a different world. a different economy. But price without context lies. If you adjust that $50 for inflation, it lands closer to 170 today, not 100, not 80, 170. Let that settle for a moment. Back then, there was no global AI build-out, no electric vehicle revolution, no massive renewable energy mandates. Silver reached that level, driven mostly by monetary stress and speculative pressure. Today, we have all of that, plus structural demand that did not exist before. This is not about calling a target. It is about understanding scale. When people say silver cannot go higher because it feels expensive, they are usually anchoring to the wrong era. They are comparing today's price to a number that lived in a completely different purchasing power environment. That mental anchor is dangerous because it convinces people the move is over long before it is even mature. History does not repeat in exact numbers. It repeats in proportions. And when you frame silver through that lens, today's prices do not look extreme, they look early. That realization is uncomfortable. It forces you to question what you thought was reasonable. But markets do not care about comfort. They care about supply, demand, and the value of money over time. And when you put those together, the ceiling most people imagine may be far lower than reality. No real market move comes without risk. Anyone who tells you otherwise is selling a story, not analysis. There are real scenarios that could slow silver down. The Federal Reserve could turn more aggressive. Rates could stay higher for longer. The dollar could strengthen. That would put pressure on all commodities, including silver. A deep global recession is another risk. If industrial activity contracts sharply, demand could soften in the short term. Geopolitical tensions could also cool. Conflicts could de-escalate. Supply chains could stabilize. All of those things matter. But here is why none of them automatically end this move. The Fed is boxed in by debt and growth. Raising rates aggressively comes with consequences the system struggles to absorb. Even in recessions, monetary policy tends to loosen. Liquidity finds its way back into hard assets. Geopolitics rarely resolve cleanly or quickly, and even if they do, industrial demand does not disappear overnight. Solar projects do not stop halfway. Data centers do not shut down. Electric vehicle production does not reverse without massive economic pain. Silver demand today is layered. Some of it is cyclical. Much of it is structural. That gives this market resilience. Pullbacks will happen. Volatility will remain high. That is the price of a real bull market. But for this move to fully reverse, multiple forces would need to align perfectly. Strong growth, tight money, falling demand, and abundant supply. That combination is rare. Which is why this feels less like a fragile rally and more like a trend that bends under pressure but does not easily break. That balance of risk and resilience is what makes this moment credible. When a market enters a phase like this, the hardest question is not where price is going, it is how to participate without losing your footing. There is no single right answer. There are trade-offs. Physical silver is the purest exposure. Coins, bars, allocated storage. When you own the metal, you own the supply constraint itself. That comes with peace of mind. But also storage costs, security concerns, and less flexibility. ETFs offer a different path. They are liquid, easy to trade, simple to scale. They work well for positioning and risk management, but they introduce counterparty risk, especially if physical tightness worsens. Then there are mining stocks. Miners add leverage. When silver rises, quality producers can rise faster, but they also carry operational risk, political risk, and management risk. They are businesses, not metal. Many experienced investors blend these approaches. Physical, for long-term security, ETFs for flexibility, miners for selective upside. The key is not chasing. It is alignment. You want an approach that matches your temperament, your time horizon, your ability to sit through volatility without making emotional decisions. This is not about swinging for the fences. It is about positioning before the story becomes obvious. There will be pullbacks. There will be headlines designed to shake confidence. A good strategy anticipates that. In moments like this, patience matters as much as conviction. Because markets reward those who prepare quietly, not those who react loudly. That mindset is what separates participation from survival. They feel quiet, incomplete, easy to ignore. That is where we are right now. Silver is moving, but it is not everywhere yet. It is not leading every headline. It is not dominating conversations at dinner tables. Most people are still focused elsewhere: technology stocks, crypto narratives. The next big thing. That is what creates a timing edge. When a story is fully understood, it is usually too late. By the time it feels obvious, price has already adjusted. Right now, silver sits in that narrow window, too advanced to be dismissed, too early to be crowded. Institutional money is positioning. Physical markets are tightening, but retail attention has not arrived. That imbalance does not last. Eventually, the narrative catches up to the price. Media coverage increases. Late buyers rush in. That is when volatility spikes and discipline gets tested. The timing edge exists before that moment. When conviction is still personal, when you do not have social proof, this is not about fear of missing out. It is about recognizing where you are in the cycle. History shows that the most rewarding decisions are often made in the absence of applause. And when the crowd finally shows up, the edge quietly disappears. That is the window silver is in right now. Every major market shift looks obvious in hindsight. The charts make sense. The headlines line up. The story feels clean. But living through it is different. In real time, it feels uncertain, lonely, full of second-guessing. That is where we are, right now. Silver is not just moving on a screen, it is reflecting deeper changes in money, in supply, in trust. Years from now, people will point to this period and say it was obvious. They will talk about structural demand, about tight supply, about policy and debt and technology. But today, it still feels debatable. That is the moment that matters. So the question is not whether silver goes higher or lower tomorrow. The question is simpler. Where are you standing while this story is being written? Are you paying attention while it is still forming? Or are you waiting for confirmation that only arrives after the opportunity has passed? Markets reward those who think independently before consensus forms. If this analysis helped you see the bigger picture, take a moment to stay connected. Subscribe to the channel. Turn on notifications. Not for predictions, but for perspective. And let me know in the comments. Do you think this is the beginning of something historic? Or do you think the move has already gone too far? Either way, this conversation is just getting started.